Hello friends. So we are studying income statement, right? And we have already covered the various aspects like gross profit and overall net profit. So we'll just quickly revise, right? We've taken the example of sales being 2000 lakh rupees, okay? And the cost of goods sold, you know, which includes opening stock, purchases, closing stock, subtract closing stock and adds wages and factory expenses. Right, we had taken it to be 1400 and we understood that gross profit would be once we subtract the cost of goods sold from the sales. So it came out to be 600. Then we had deducted the operating expenses, which include the depreciation and any other administrative and similar costs, all right, of 300 rupees. Once we subtracted the operating expenses from your gross profit, the remaining amount that we were left was earnings before interest and taxes. That is your operating income or operating profit. Alright, and this came down to 300. Finally, you subtracted the interest, the interest that you had to pay in lieu of the borrowings. Okay, and this came out to 51. All right, and therefore you were left with earnings before tax or profit before tax, which was 249. Right, taking tax at 40%. Once you subtracted that, you were left with the net profit, that is earnings after tax or profit after tax, which came down to 149 in our example. Finally, we had also taken into consideration the appropriation of this profit, wherein we started from the net profit, that is of 149 lakh rupees. We first subtracted the preference dividend from here, alright, which goes to your preference share holders, okay, against preference share capital. This came down to around 6 lakh rupees, okay, and then the earnings which were available to the equity shareholders, alright, in lieu of equity share capital and reserve and surplus was 143 lakh rupees. Okay, now from this 143 lakh rupees, the company or the management decided to give around 40%, for the retained earnings, and finally the equity dividend of 86 lakh rupees was divided among the equity shareholders. All right. This example further, we know how we have come to this net profit. All right, now we'll talk about some of the ratios. Now see, whenever you're talking about income, okay, there are two aspects, and one is your sales, okay, and in terms of sales, either there would be some kind of profit, okay, or there will be some cost, okay. So the ratios that we are going to talk about now, they will be whether we are talking about, the discussing about the profitability or the loss in terms of sales or the expenses, okay, with respect to your sales. So we will discuss two kind of ratios. One is the profitability ratio and the other one is expense ratios. Now the very first profitability ratio will come directly from the gross profit, okay, and that is gross profit ratio. Okay. Now what is your gross profit? Gross profit is simply your sales minus cost of goods sold, okay. So gross profit ratio becomes gross profit divided by sales into 100. Therefore the value will become 600 upon 2000, which will be your 30%, okay. Next is net profit ratio. Okay, let me just write down 600 upon 2000 into 100. Net profit would be, your net profit came down to 149. So 149 upon 2000 into 100. Finally, what will be your operating profit ratio? As I told you, your earnings before interest and taxes is your operating income or your operating profit, right? So operating profit ratio would be this operating profit, that is 300 divided by 2000 into 100. Alright. So you can see that the profit is calculated with respect to the common denominator, that is sales. Alright. So these profits are very easy to learn. Alright. You know what gross profit is, you know what net profit is, and you know what operating profit is. Alright. When you're talking about gross profit and you get this value, alright, what this means is that for every 100 rupees, 30 rupees are your profit, okay, gross profit, and 70 rupees was the cost of goods sold, right? Because gross profit plus cost of goods sold will be completely sales, right? Okay, so that means 70 rupees is your cost of goods sold. So this is one view, this is the profitability ratio. Similarly, if you will calculate the expenses, you know, that is, let's say 70, you know, that is the cost of goods sold upon sales, that will give you one of the expense ratios. All right, so the very first is cost of goods sold ratio, which is cost of goods sold, okay, which is 1400 upon sales, okay, into 100. So this will come out to 70. Okay, so these both are corresponding to each other. One is the expenses, the other one is gross profit. The second one is operating expense ratio. Again, as the name suggests, what kind of expenses are you going to divide here? The operating expense. What was the value? 300. So here it will be 300 divided by 2000 into 100. Okay. And the third kind of expense ratio is your operating ratio. Now do not get confused between these three ratios. One is operating profit, the key term being profit here. Alright, so you divide operating profit by sales, and operating profit is your EBIT or operating income. Okay, the second ratio is an expense ratio, which is operating expense ratio. Again, as the name suggests very clearly, here you have to take the operating expenses, divide them by sales and multiply by 100. However, the third kind of expense ratio is operating ratio, and this means you take both the costs, both the kind of expenses, that is cost of goods sold and the operating expenses. Okay, you take both these costs and then you divide them by the sales and you will get your value. So what is the cost of goods sold? That is 1400. What is the operating expenses? 300 divided by 2000. So 1700 upon 2000 is your operating ratio. The third kind of ratio is return ratio. Alright. Now what does return mean? Return means what that, like, if you invested something, right? What How much money are you getting in return for this investment? Alright. And very based on this very definition, okay, the very first ratio is your return on investment or return on capital employed. Okay, and what would this be? Return on capital employed means you have to determine what is the return or what is the profit, what is, how much have you earned against the capital employed. So in the denominator you will take capital, okay, in the numerator you will take your profit, which is your EBIT, the earning before interest and taxes. So 300 upon capital, you remember in the last example we had taken capital to be 500 lakh here. So 500 lakh rupees capital. So So you will take 300 upon 500, and this will give you your return on investment. The next one is return on assets, wherein you take the profit after tax or the net profit. Alright, so 149 upon the average total assets, whatever the total assets value is. And again, in our previous example, we had taken the value of total assets to be 600. Alright, so this will be your return on assets. Now, once first you have calculated return on your capital employed, then you have calculated return on average total assets. Now, the third one is return on equity. Okay. Now, remember, here we have talked about capital employed, so therefore we have taken the complete capital. All right, whether it was the owner's fund or the borrowed fund. All right, but in return on equity, okay, this will be calculated only on the owner's fund. All right, because it is the denominator has to be equity, and equity is what? Your preference share capital, your shareholder equity, and the reserve and surplus. Okay, so you will take your profit after tax, that is the net profit, okay, and average shareholder fund, which was, as you can see, it was equity share capital plus reserve and surplus plus preference share capital. The value was 200 lakh rupees. All right, so this will be your return on equity. All right, so far we have covered three kind of ratios: profitability ratio, in which you calculate gross profit ratio, which is gross profit divided by sales. Then you have net profit ratio, again the now numerator is net profit and you divide it by sales. Third one is operating profit, in which you divide the operating profit or operating income, alright, or EBIT by sales. The second kind of ratio is expense ratios, and in this you calculate the different kind of expenses, whether they're the cost of goods sold, whether they're operating expense, or the overall operating ratio, in which you take both the kind of costs, that is the cost of goods sold as well as the operating expenses, and divided by sales. The third kind of ratios are the return ratios, in which you calculate how much return you have received against either your capital employed, alright, or against your assets, or against the equity, which is that of the shareholders. Okay, the key point to remember here is when you're calculating the gross, that is the return on investment, okay, or return on capital employed, in that case you will take earnings before interest and tax, that is the operating income, in the numerator, whereas in return on assets and return on equity you will take profit after tax, that is your net profit. All right, so the next part is stock market ratios. Now these ratios have to do, with the per share value, and this share value is of three kinds. Okay, first of all, it is the face value. Now, what is face value? This is the value at which the shares were first allotted. Okay, the second one is your market price, market value or market price. Okay, you can also call it current market price, and this is the value at which the shares are currently being sold and bought in the stock market. All right, the third one is, and this book value, you have already studied that this is calculated based on the assets of the company, and you evaluate that based on the net worth of the company, what how much should be the actual value of the per share. All right. So coming to the first ratio, the very first ratio is earnings per share. All right. Now, what does this mean? This means that for the equity shareholders, what will be the earnings, available based on the divided by the total number of equity shares. All right. So you remember that in our appropriation of profits also we had studied that earnings available to equity shareholders. You first take your net profit, right? And once you subtract the preference dividend from it, the amount that you are left with is the earnings available to equity shareholder. Therefore, this ratio can also be written as PAT minus preference dividend divided by number of equity shares. Okay, so in the previous example that we had taken, it was 149 lakh was the PAT, okay, and 6 lakh was the preference dividend. Therefore, 143 lakhs, okay, divided by number of equity shares. Now, you, number of equity shares. So remember that the equity capital in the example, right, was 100 lakh rupees. Okay. Now, assuming that the face value of these shares is rupees 10. Okay. Therefore, number of equity shares would be 10 lakh. Okay. So, therefore, 14.3 is the value of earnings per share. What does this mean? That for each share of the company, that the equity shareholders have, they have earned rupees 14.3. Okay. Next is dividend per share. And in this, you calculate the total equity dividend, all right, divided by the number of equity shares. Okay. Further, in our example, we had calculated that the equity dividend, that after 143 lakh rupees, we had taken 40% in our retained earnings, and therefore the equity dividend that was left was 86 lakh rupees. Okay, and the number of equity shares 10 lakh. Therefore, 8.6 is the dividend per share. Next one is dividend payout ratio. So basically, what is the dividend per earning? All right. So how you calculate this is dividend per share divided by earnings per share into 100. So this was 14.3. This was 8.6. So therefore, 8.6 upon 14.3 into 100 will give you the value of dividend payout ratio, which comes down to be, okay, which comes down to 60%. Now there's one thing which is noteworthy here. You remember that in appropriation of profits, we had taken that 40% of the overall, the dividend of the earnings available to equity shareholders, we had taken as retained earnings, right? Which means that 60% of the earnings available were the equity dividend, right? And this is the same as your dividend payout ratio. Okay. Basically, what is the payout of the dividend, all right, which is the equity dividend? So if you are from the total earnings available to the equity shareholders, if you are taking 40% as the retained earnings or in the reserve and surplus, so 60% is left, and therefore this is your dividend payout ratio, all right, and 8.6 by 14.3, or you can also take this formula and this will give you the value. By this, the other thing which is naturally which comes down, what is the retention ratio? Alright, and the retention ratio will obviously be 40%, the amount that you are retaining in the company from the earnings available. Alright, and this can be calculated by subtracting the dividend payout ratio, alright, from 100. So 100 minus 60 will give you 40%, which was the retained earnings. Alright. So the next one is price earning ratio. As the name suggests, you have to take the price, and this ratio is between the price and the earnings. Alright. So what is this price? This price is your current market price. Okay. This price is the current market price at which the trading is being held in the stock market. Alright. Let's assume that this is 200 rupees. Alright. And this has to be divided by the earning. Here what we mean by earnings is the earning per share. Alright. And the earning per share is 14.3. So you divide this by 14.3, the value comes around 14. So what does this mean? This means that the current market price is 14 times of the earning per share. Alright. That the market price is 14 times the earning per share. Alright. Now the next one is dividend yield ratio. Now dividend yield ratio, basically how much of the dividend will be yielded, or how much dividend you will get. Alright, at the current market price. So how you calculate this is by dividing the dividend per share value by the current market price. So 8.6 by 200 into 100. Therefore you get 4.3%. Now what does this mean? See, in the current scenario, when you invest 200 rupees, you're getting a dividend of 8.6 rupees. Okay. So this means that the return that you are getting in the form of dividend is at 4.3%. Okay. So therefore, if you invest, in let's say 1 lakh shares. Okay. So the dividend that you will get is at 4.3%. Okay, and therefore the amount that you will get is 4300 rupees in the form of dividend if you buy the 1 lakh shares at 200, the market price of 200 rupees. Now the next one is earnings yield rate, and here what we have to calculate is what is the total earning per share. All right, regardless of whether what amount is going into dividend or what is the retained earnings. All right, regardless of that, what is the final, how much will I earn. Okay, what is the final payout per share. So this is calculated by dividing the earning per share, that was 14.3, by the current market price. All right, so you get 7.15. All right, what does this mean? This means that at the current market price, the earnings that you are getting is at 7.15%, which brings us to the very last stock market ratio, which is market value to book value ratio. Right? The name itself suggested you divide the market value, which is the market price per share, right, by the book value ratio. So let's say that in this example the book value stood at 50 rupees. What does this mean? This means that the trading of the shares is going on at 4 times the the theoretical book value. All right, that the share is being sold and traded at 4 times the value of what has been calculated from the based on the assets and the net worth. All right, So these were the with this we complete the different ratios. All right, the different stock market ratios we'll quickly revise. The very first one is earnings per share, all right, in which you calculate the earnings available to the equity shareholders divided by the number of equity shares, all right. And as you know, earnings available to equity shareholder is also net profit or PAT minus the preference dividend. The second one is dividend per share, and in this you calculate by dividing the total equity dividend. All right, this is the equity dividend which is paid out after first you uh, uh, give the preference dividend from the PAT. All right, and then once you have taken whatever the retained earnings are there, all right, so PAT minus preference dividend, and then you remove the retained earnings, then you will get the total equity dividend. All right, and then you divide this by total number of equity shares. That will give you your dividend per share. In our previous example, earnings per share, the this amount was 143 lakh rupees. All right, this was 10 lakh, assuming the face value of 10 rupees. All right, so this earnings per share was 14.3. Okay, your dividend per share, because total equity dividend was 86 lakh rupees, so dividend per share stood at 8.6. Okay, then we calculated dividend payout ratio, which is your dividend per share divided by earnings per share. So therefore 8.6 upon 14.3 into 100, which is 60%. And you also know that this is also, the amount that you are basically dividing it, giving to the equity shareholders in the form of equity dividend, which was 60%, because for 40% of the total earnings, earnings available to the equity shareholders, we had taken as retained earnings. All right, so therefore it is also 60%. Okay. And because from the total earnings available to the equity shareholders, you either keep some in the retained earnings or you give them in the form of equity dividend. Therefore, if you have to calculate the retention payout or the retention ratio, in that case it will be 100 minus the dividend payout ratio. So therefore 100 minus 60, which is equal to 40%. Next one is price earning ratio, and this is very simple, in which you calculate the price divided by the earnings, which is your current market price divided by earning per share. Okay, so in the example we have taken that the current market price is at 200 rupees, the book value is at 50 rupees, and the face value was at rupees 10. Okay, so therefore current market price by earnings per share, that is 14.3, 14. Therefore this means that the current market price of the shares is 14.3, 14 times the earning per share. Next one is dividend yield ratio. So basically, if you invest in the shares of this organization today, what is the percentage of dividend that you are getting? And therefore this is calculated by dividing the dividend per share value by the current market price. Okay, which is your 8.6 by 200 into 100, therefore 4.3%. Okay. The next one is earnings yield ratio, that regardless of the form of the what I'm earning, whether it is in the form of dividend or in the total equity amount, okay, whatever I'm getting, but if I invest in this share, so here the value is earnings per share, that is 14.3 divided by 200, which is 7.12%. That means I will get a return of 7.12%. All right. And finally, market value to book value ratio, which means 200 upon 50, which means 4 times. Therefore, the share of this company is being traded at 4 times the calculated book value. All right.